What did we expect exactly? Stocks, which had essentially been flat in 2016 until the presidential election, suddenly skyrocketed for 14 months straight. By January 2018, the Dow had soared 49%, the S&P 500 31%, the Nasdaq 44% in just 14 months, on top of the already ludicrous levels achieved after 8 years of scorched earth monetary policies. The Fangman stocks, Facebook, Amazon, Netflix, Google, Microsoft, Apple, and Nvidia, doubled their combined market cap after the presidential election to $4.6 trillion at the peak at the end of August. That gained $2.3 trillion with a T over those 22 months. Housing prices, too, have followed that pattern. The real economy, particularly the goods-based economy, has followed the pattern. The transportation sector went into an all-out boom. Oil and gas drilling emerged from the oil bust and turned into a boom in 2017. Consumers went on a spending spree, and retail spending surged, driven by the boom in e-commerce. This phenomenon is called the Trump bump. A surge of exuberance among consumers, investors, homebuyers, speculators, business decision makers, and the like, whether Trump had anything to do with it or not. It started after the presidential election of 2016, but now the effects are petering out. So, what will happen if this exuberance is deflating? Ladies and gentlemen, I'm Wolf Richter of WOLFSTREET.com, and you're listening to the Wolf Street Report. It's not like stocks or real estate are falling off a cliff or anything, but the effects of the Trump bump are starting to reverse just about across the board, but on different timetables. This is turning the Trump bump into a true bump with an upslope and a downslope. The 7 Fangman stocks have lost a combined 16% or $735 billion in market cap since the end of August. The S&P 500 stock index is down 7% from the peak in September, and it's up only 2% year to date. Housing in the most expensive markets was seeing weakening fundamentals in 2016, but a couple of months after the presidential election, prices began to skyrocket even as sales volume was lethargic. This includes the West Coast, the greater Los Angeles area, the Bay Area, the Portland Metro, and the Seattle Metro. In places where people were mortified by the election of Trump, home prices surged. For example, in San Francisco, single-family house prices skyrocketed 40% from the election to the peak in February 2018. Trump's tax policies removed some subsidies for home ownership in expensive states, such as California, and prices might logically have taken a nosedive right then and there, but the opposite happened and home prices surged all along the West Coast. But this too has ended. The fundamentals in these markets and in many markets across the United States are deteriorating, with sales declining from already low levels, with unsold inventories piling up, and with the number of price reductions plowing through the roof. This is a sign that sellers are trying to find where the buyers are, and the buyers have moved lower. Forget the bidding wars. The market is still good and liquidity is still there, but sellers need to abandon their aspirational prices, their wishful thinking. They need to roll up their sleeves and reduce listing prices and make deals. And this is putting pressures on selling prices. This has been playing out in other housing markets too, and in many areas across the country. The subcutaneous fundamentals in those housing markets are weakening, and the boom is petering out. The issues in the housing market are largely due to a toxic mix of sky-high prices after years of blistering asset price inflation and rising mortgage interest rates. Buyers say enough is enough, and now they're taking the time. But why did that market boom so much in 2017, even as interest rates were already rising? And why is the hot air hissing out of it now? That's the phenomenon of the Trump bump. The oil and gas sector also had its bump. The sector is huge in the United States. The fracking boom has made the U.S. the largest oil and natural gas producer in the world. This sector plays a big role in industrial production. The equipment needs to be manufactured. There are specialized services involved. There's a large high-tech component, and the sector creates lots of highly paid jobs from oil field workers to tech specialists. The oil and gas sector experienced a stunning bust from mid-2014 through early 2016 when oil prices collapsed by nearly 70%. A gaggle of smaller companies filed for bankruptcy, but then, and this happened well before the election, Wall Street doused the sector with new money and the boom began all over again, and oil prices too recovered, more than doubling to $76 a barrel, so everything was hunky-dory. Until it wasn't. Oil prices turned around at the beginning of October and have by now plunged about 28%. But there are some big exceptions to the Trump bump phenomenon. Bonds have been taking a licking since December 2016. It started with the highest quality bonds with Treasury securities, and it has worked its way down. High-grade corporate debt started to sell off, then the higher quality junk debt started to sell off, and now even the lowest rated junk debt has entered the sell-off. The sell-off in bonds is in part due to the Fed's interest rate hikes. This has been the slowest rate hike cycle ever. It has been going on for 3 years, and the Fed has raised rates only in small steps, spread far apart. And this rate hike cycle may well last another year or longer. It's so slow that the economy has been able to adjust to it. This isn't a shock and awe campaign. It's a well-communicated, slow-mo rise in interest rates that, by comparison, makes watching grass grow a suspenseful activity. It's so slow that markets outside of the bond market largely blew off the Fed for the longest time, though this year they got the memo. This goes from emerging market bonds and stocks that have taken a big beating to the glittery core of the U.S. stock markets, the FANGMAN stocks that are now down 16%. The Trump bump has been very visible in the real economy too, particularly in the goods-based sector. Retail sales surged after the election, fueled by booming online sales. In the 2 years before the presidential election, retail sales had grown at an annual rate between 1 and 3%. But after the election, retail sales surged to nearly 7%. Sheer shopping exuberance. But consumers, too, are now starting to fall back some. They're still buying, but growth has slowed. And there were some exceptions. Sales of new vehicles peaked in 2016 and have since edged down. But used vehicles are very strong. Both of these factors are a function of the toxic mix of sky-high new vehicle prices and rising interest rates. Auto sales have also gotten suffocated by billowing smoke from crashed and burned subprime auto loans. So the industry has tightened up its lending standards, and subprime-rated buyers can no longer buy a new vehicle as easily. They have to buy used instead. Auto sales matter. They account for 21% of total sales. And the industry, after these boom years through 2016, is facing a reckoning. And the Trump bump is visible in the transportation sector. Services can be delivered in a myriad ways, but goods need to be shipped. The slowdown in the goods-based sector in 2015 and 2016 was in part due to an earlier inventory buildup that needed to be dealt with when sales didn't follow. Businesses cut their orders to whittle down their inventories, and this spread across the economy and up the supply chains and caused the entire goods-based sector to slow down. And the slowdown in the goods-based sector was also in part to the oil bust when drilling activities in 2015 and 2016 were slashed. All kinds of equipment and supplies didn't need to be manufactured and delivered. The oil bust had a secondary impact on the construction sector in the oil patch, such as in Houston, where a historic office construction boom basically collapsed. The slowdown in the goods-based sector dragged down overall GDP growth in 2016 to just 1.6%, the worst since the financial crisis. So now these things are coming full circle. 1. The price of oil has dropped again under the impact of the U.S. production boom. This puts the entire oil and gas sector at risk again. 2. Inventories have ballooned again. This is in part due to threatened trade tariffs that companies try to front-run. Port activities and freight volume have soared this year because of it. But at some point, companies will whittle down their inventories again by cutting orders, which will again ricochet across the goods-based sector and up the supply chains. 3. Buying big-ticket items like a house or a car is getting a lot more expensive due to higher rates and higher prices. Double whammy, which translates into a monthly payment shock. 4. The reduction of tax subsidies for home ownership will start to bite in terms of dollars and cents when people do their taxes, which will be early next year. This will leave them less money to spend on other things. 5. The payroll tax cuts in terms of their year-over-year effect on growth will no longer boost the numbers in 2019. 6. Consumers will have to redirect money from buying goods and services to paying for interest. 7. The corporate sector, which is leveraged to very precarious levels and which has to refinance this debt at higher rates going forward, will struggle with this new reality, and a lot of companies will end up restructuring the debts in bankruptcy court at the expense of shareholders and some creditors. What this boils down to is this: the exuberance is getting squeezed out of the markets, consumers and companies alike. Consumers will still buy, though growth will slow to normal growth rates. Companies will trim their projections and start cutting costs, which in a chain reaction will eat into the suppliers' revenues, and they have already started the process. Markets will still be liquid because there's a huge amount of money waiting to be deployed, sitting by the billions in specialty funds designed to pounce on any sell-off. Any major sell-off will be followed by major dip buying, but in this manner, they'll zigzag lower little by little. The most inflated housing markets in the US will lose steam in the same manner, gradually in small increments, with sellers trying to make deals with ever more circumspect and reluctant buyers whose buying power is getting squeezed by rising mortgage rates. These effects will be slow enough to where they don't scare the Fed into changing policy. Instead of a recession, it will look like some sort of normalization after a crazy bout of asset price inflation and market exuberance. By bringing down asset prices gradually, that is, by bringing down collateral values, the Fed is removing some risks from the financial system. It has been talking about this for years under the terms of enhancing quote-unquote financial stability. Now it's doing it. And this is what my finely honed crystal ball says. Unless something big breaks next year, such as China's economic and financial machinery locking up, this is what we're going to see. An economy that is growing but at a slower rate than now, accompanied by the continued unwinding of market exuberance, with some hairy sell-offs and bounces that together will be painful but slow enough to keep the Fed on track next year. That's my story, and I'm sticking to it. Ladies and gentlemen, I'm Wolf Richter of WOLFSTREET.com. Thank you for listening to the Wolf Street Report.